That is all the stock markets needed, it would seem. A dovish Fed, some numbers out of the U.S. economy that were a little bit better, and we're off to the races. Or are we? Welcome to Macro Money. This is Ilya Spivak, head of Global Macro, and we are going to talk about this absolutely explosive performance from markets in the wake of the Fed's actions, and then look forward. Because naturally, the question from here, as ever, for forward-looking markets is, well, now that speculation has become reality and the Fed has endorsed everybody's dovish myth-making, what's next? And can we sustain this blistering advance? So, first we're going to look at how this rally happened and what exactly made for the ingredients that put it all together. And then we're going to take a look at what catalysts are there to sustain the move higher, what headwinds are lining up to push back. So, not surprisingly, the question on everybody's mind surely is, can it keep going? Well, let's start to break this down. So first, there has been an unmistakably dovish turn in Fed policy expectations. That much we knew already. November was a blistering adjustment. We can see here that the big dots on the curve there are the November FOMC. That's not this one that just passed, clearly, but the one that was the preceding meeting. And we can see that over the course of November and into December, there was a potent dovish shift. You can see that in the little dots line here, which is from a week ago. So there is the path that was expected at the beginning of November. Here is the path that was there 1 week back from today. Now we can see here that the current curve is even more dovish, but that the adjustment has been somewhat modest. Nevertheless, we are even more dovish now in these expectations than we were a week ago. So clearly the Fed has had an impact. Clearly the Fed has told markets something that they had not discounted before and have discounted now. Because for whatever reason, there was more dovish adjustment to be had thanks to the Fed than there was in the market before the Fed spoke. We can see this in very sharp relief if we look at the amount of rate cuts that are now in the forecast for next year. That's the gray bars that you see in front of you there. So this tells us how many rate cuts are on the menu between now and next year's December FOMC. So we can see here, markets are now looking at something on the order of 1.5% in cuts. That's 6 cuts at 25 basis points or a quarter percentage point each. We can see how the markets have responded. Here's the S&P soaring on this news. And of course, this has been a story that's been with us since the beginning of November. We can see here that really since mid-year, the story has been when there are fewer rate cuts on the menu, stocks go down. When there are more rate cuts on the menu, stocks go up. This is, of course, not at all surprising. When there are lower lending rates, when there is the prospect of cheaper money on the horizon, businesses, individuals, anybody that might need to use money for any kind of economic activity you can imagine is going to have an easier time getting it and a cheaper cost to getting it. So economic activity might be expected to get a boost. So you might be able to surmise that you should see positive response from growth geared assets like stocks. It is that much easier to borrow money to expand a business, to grow earnings when the money is cheaper. If there is some sort of economic turmoil, it is that much easier to digest that turmoil if whatever money you lose can be more cheaply gotten back because borrowing costs have declined. So this is a very understandably a positive story for stocks. It is also a very understandably negative story for the US dollar. You see something very similar here where you have the build out of more rate cuts pushing the dollar toward its recent lows. And when there are fewer rate cuts, the dollar has been higher. When there are more of them, it's been lower. Needless to say, that too makes sense. If you make the dollar cheaper to borrow, well, that borrowing is somebody else's lending income. So if it's cheaper to borrow dollars, then it's less lucrative to lend them, and there is less appetite for holding them as a consequence. So all of this makes sense. But of course, that was the last Fed policy meeting of the year. So the question now in front of us, now that the Fed has essentially endorsed everybody's speculation, it said as early as 2 weeks ago that it is too early to talk about rate cuts. That's from Jay Powell himself. Well, 2 weeks later, it wasn't too early because boy, did he lean in. We can see the extent to which the markets cheered right here in an unambiguous way. So now that this speculation has ostensibly become reality, now that the Fed has said, yes, markets, I will follow these hopeful speculation trends that you've established. There will be cuts. We are done raising rates, most likely. What remains to keep this rally aloft? And has the situation economically underpinned anything about this? Or is it purely cheaper money that is the catalyst? Well, to do that, we'd have to take a look at how global growth is doing. And as ever, we are reminded that global growth basically splits down the middle between three key pivotal economies and everyone else. And when this breaks down, what we see is about a quarter, a little bit less, of global GDP is the United States. About another 12% is the Eurozone. About another 16% is China. Between those three, you have 50% of global growth. Everybody else is the other 50. This tells a story that's very clear-cut. First, much of the rest of world 50% depends on demand from the three big economies. Think Canada or Mexico and the US, all of Central Europe and most of Nordic Europe and the Eurozone. Almost all global commodity producers, think Australia, New Zealand, the big commodity producers in South America, think Peru and Chile and Brazil, almost all of Southeast Asia, all of them depend on China. So these three economies really have even more impact than the 50% that they are directly responsible for, because without that 50%, the other 50% flounders. It is not an offset, it is a dependency. The other 50% is mostly made up of vendors serving the demand in the other three. It gets deeper. China isn't so much at the front of the consumption line, it's in the middle. So the way the global business cycle tends to work is raw materials and semi-finished goods from rest of world 50% go through China, where they are either finished or more so finished. China tends to be the value add middle for the global supply chain and has become less of one as a consequence of COVID, but certainly still a very important one, certainly still the largest one for now. But the main story in China through COVID and since their reopening in December of 2022 has been that growth has been anemic because demand from the US and the Eurozone has not returned to power China to the extent that it used to before. We can see that here. And incidentally, also see where these top three economies now sit. China, as we can see here, never really got off the ground since reopening in December of 2022, because by then, demand from the US and the Eurozone was already on the downswing. These are composite PMI numbers. They are showing the pace at which these three economies and economic activity in them are growing or shrinking. 50 is the center line at which we are at standstill. Above 50 is growth. Below 50 is contraction. The more you go above 50, the faster the growth. The further you go below 50, the faster the contraction. So two things that we see here. Number one, growth following the COVID lockdowns and the catch-up thereafter already peaked by mid-2021 in both the US and the Eurozone. It has moved lower since, and in the case of the Eurozone, we are now looking at an economy that is many months into contraction territory. It is clearly here sub 50. A U.S. economy that is at standstill, only a hair above total standstill at 50.7, and a Chinese economy that's in a very similar boat, only a hair above complete stasis, just a sprinkling of growth. And so, as we look at all of this, we consider, well, if these three economies are driving the global growth story, and China only kind of, because it also is dependent on end demand from the US and the Eurozone and is floundering because it hasn't seen it, well, then really this is about US and Eurozone growth and some about what's going on in China. And all three of them, but certainly the US and the Eurozone, are now either in contraction already or basically stuck. We are going to get a update on this. December numbers for the UK, the Eurozone, and the US are due. We're going to get China next week. But what we see here is things don't get much better. The US slows a bit. The Eurozone is expected to come up a bit, but still remain in contraction territory. The UK is seen perking up a hair, but that doesn't make a dent in the pie to a large extent. The UK economy at this point isn't one of these dominant, huge parts of the global whole that could ostensibly offset weakness in some of the other major nodes. It's just not big enough by itself at this point. And so what we're looking at here then is standstill, and expectations suggesting that standstill isn't going to get much better. Because if the two critical economies are the US and the Eurozone, well, things aren't looking to get a whole lot better for either of them. Still contraction on the continent in Europe, slower growth in the US come December. Once we put this all together, we seem to be on course for the slowest quarter of global growth in the fourth quarter of this year since the first quarter of 2022. So we are very much flirting here with a global recession that seems inescapable. If this is the pie, well, how does the pie grow if almost all of it is dependent on what happens in the green and blue sections, and they're, if not in recession already, then trending toward stasis? What's more, we can clearly see that none of this stuff got any better through the past 2-3 months, the very period where we've had this blistering stocks rally. So this is where stocks are surging. Are we getting any better on global growth here? No, as a matter of fact. The best case here is we're getting a little bit of a flat line. And if you're China, things are actually getting worse. So once we put all of this together, we say, well, okay, well, do the markets care? Yes, growth is slowing, but maybe the markets don't care. Maybe what they're saying is, well, okay, so it's slowing, but we're going to get the cheaper money. Everything will be all right. Well, if we look at the way that inflation expectations have performed, the markets are yelling at these central banks that the time to ease has come, because even as more and more easing is being baked into the system, inflation expectations are falling. As if to say to markets, if you were to cut rates, inflation is not going to go up. As a matter of fact, it might come down because you've done enough damage, you've inflicted enough pain on the global economy that at this stage, it needs rate cuts. It needs easing because the global business cycle is in bad shape. You can see that in the US here. And it's an easy juxtaposition. Here is the move in policy in November. More cuts. Well, if there's more cuts, you'd think inflation might be let out of the bag if the economy was going to roar higher thanks to those cuts. That's not what the market sees. Inflation expectations are going down at the very same time that those cuts are being baked in. It's the very same story in Europe. Just as there is the dovish adjustment in policy rates in the Eurozone and in the UK, the same adjustment holds. Inflation expectations, in this case from the swaps market, are going down, not up, as you get expectations for easing. Needless to say, this should be worrying. Because now that the markets have taken the steam out of speculation around rate cuts, because ostensibly the Fed has given them what they wanted to hear, they reacted in the way that they were liable to react, and there isn't much more to discount here. The next question, naturally, is why is all of this cutting coming, and why are the markets screaming that they need it? Well, it's because the global economy is at a standstill. And things are not shaping up in the direction of improvement. As a matter of fact, as we say, with the way that this is arranged, a global recession seems essentially inescapable. I say essentially because, of course, nobody can tell the future. Nobody knows with perfect clarity. A crystal ball does not exist. But it's very difficult to imagine why a global recession would be an improbable way forward from here. So, the next question, of course, is, well, how do the markets react now that asset prices have surged and the dollar has moved aggressively lower? If the next level of the conversation is, well, good, we've discounted the cuts, now let's look at whether the valuations for these assets are actually underpinned by the real economy. And the first thing that immediately comes to mind is the typical relationship between Fed tightening cycles and market volatility. The Fed has told us that we tend to have something like a 12 to 18 month lag for a single rate move, be it a hike or a cut, to actually be priced into the economy. What we see here in the orange is the VIX index of S&P 500 implied options volatility, the market's so-called fear gauge. Now, we should say that volatility here is biased on the downside. The VIX doesn't spike higher because the market is volatile if the volatility is to go higher. It only spikes if the volatility is to go lower. So what we see here is that VIX index overlaid with a 24-month lag, so a full 2 years, over the Fed interest rate path. And what we find is that as the Fed raises rates, markets tend to fall about 2 years later. That, of course, comports with what the Fed tells us about an 18-month give or take absorption cycle. Add in some months here for the market to actually recognize that the economic environment has shifted. And you find that about 2 years after the start of a tightening cycle, the Fed invariably breaks something in financial markets. And this is something that goes all the way back 30, 40 years. So let's look at some of these recent cycles. The early 90s, Fed tightening cycle, 24 months later, run up in volatility. More tightening, more volatility. The 04 cycle, tightening, 2 years later, the 08 financial crisis. Most recently, now obviously COVID is a bit of a different story here, and so the timing is a bit off, but it nevertheless comports give or take. And I think one can say, on the one hand, there's not enough instances here to make this statistically significant. That's certainly an accurate critique. But also, we find that if this pattern continues to hold, then we're just on the cusp of an upturn. And indeed, volatility has dropped to levels low enough that this would be about where an upturn could be expected to occur. There is much more air above where the VIX is now than below. So if the focus for markets is going to switch to becoming the pain from this tightening cycle, the headwind that this tightening cycle now presents for earnings, for employment, for economic activity of every stripe, well, then the cheering of cheaper money, now that speculation about it has been endorsed into reality by the Fed's actions, now we may very well be on the cusp of what is the next ugly sell-off. Now, is it going to happen in January? Who knows? As we say, this is about 2 years. So give or take a few months in either direction, who's to say how this perfectly lines up? But we are certainly, it would seem, within the window at which things start to look a bit worrying. One particular catalyst that might activate this dynamic is what is happening on the debt side of things. And we've talked about this before here on Macro Money, but of course, one of the biggest worries for the sustainability of these markets is the need to refinance a historically giant pile of debt at much higher interest rates. Now, of course, not all of this incredible pile is due to roll over next year. And we're looking at absolutely astronomical levels here, approaching $350 to $370 trillion in global public and private sector debt. So this is an absolutely enormous pile of debt. Not all of it, needless to say, or even close to most of it, is due to roll over next year in particular. In fact, it's going to increasingly roll over the coming years. The average maturity on this stuff tends to be about 4 years. If everything is sort of tossed into the bucket and averaged out. So we do know that there's quite a bit here, and in fact, most of it, that was incurred at laughable interest rates relative to where that borrowing cost benchmark stands now. We also know that if growth is slowing, servicing these debts will become more difficult, because in the ratio of debt to GDP, which is the line that you see there, if you pull the numerator higher and the denominator lower, so needless to say, we've not stopped incurring debt. If anything, we continue to grow it. But at the same time, you also weaken growth such that the denominator in the debt to GDP calculus gets smaller. Well, then more and more of your GDP that you're able to have has to go toward debt servicing rather than growth. So it seems difficult to envision a situation in which out of this giant pile, everybody can pay debts without interruption, and anybody due to roll over these debts can pay them without interruption at interest rates that are between 300 and 500 times higher, give or take. S&P Global also estimates that we are looking at about a third of this pile tied to floating interest rates, which means that even if they don't roll over, the cost to financing, to keeping these things alive, have astronomically increased. So the question then becomes, okay, well, it's going to take a whole lot of money now to pay down some of this stuff, to service it, much more than it did before. Well, where does that money come from? Well, if asset markets are this high, raising cash might mean liquidation, because paying these debts is going to require cash. What does one liquidate? Well, those things that are liquid to begin with, things that are easy to sell, things that are not terribly tied down, like stocks. And so what you face as the year comes ahead is not only this appearance of danger, but also the match that may light the fuse. So even as we look at this blistering rally, the question naturally is it based on economic fundamentals, whereby companies make more money, grow earnings, expand multiples, or is it based on the prospect of cheap money, as it seems to be? And now that that part of the story is priced in, when do we start to care about the reason why the money is going to get cheap? And at what point does the whole thing deflate because it's run out of reasons to go higher in a global recession scenario? And that is macro money for today. This is our last show for this week. We're here Monday through Thursday every week right after overtime, a show that I co-host with Chris Vecchio and Dylan Radigan, looking at what happened on Wall Street on a given day and what it means for what comes next. I'm back on with Chris for Futures Power Hour on Fridays, on with Tom and Tony for First Call on Sundays, writing for the News and Insights section of tastylive.com, and opining sporadically on the platform formerly known as Twitter at Ilya Spivak. Thanks very much for joining. Macro Money will be back next week. Take care.